So today I am talking about the role of market makers. I'm from AlphaLab Capital, so really quick, just want to introduce AlphaLab Capital and our background. We were founded in 2017. We have about 80 people globally, and we're market makers in centralized, decentralized, and NFT exchanges. So, first of all, what is market making? Market making, at its most fundamental, is the act of providing liquidity to marketplaces so that people can transact what they want, when they want, and in the sizes that they want. I think everyone here has probably interacted with a market maker in the real world. So the example that I always like to use is the money changers that you find at airports, right? So if you're flying in from Europe, you give them some euros, they give you some US dollars. If you're hopping on a flight to Paris, you give them some US dollars, they give you some euros. The function of these money changers at airports is so that people can transact the currencies that they want to transact, when they want to transact, and in the sizes that they want to transact in. Let's take a moment and imagine what the world would look like at airports if these money changers didn't exist. So I'm about to get on a flight to Europe. I'm running around the airport. I'm trying to find somebody who just came in from Paris or Berlin so I can swap my USD for their euros. But maybe I want to change $100 and they want to change $500, or we can't agree on an exchange rate, right? It would be extremely inefficient, it would be extremely expensive, and it would be a huge hassle for everybody. So the role of market makers is really to make exchanges easier. And market makers exist in all kinds of markets. So FX markets is one, equities markets, crypto markets, but they also exist in markets like ride sharing, e-commerce marketplaces like Amazon. So I'm going to focus in on the financial markets specifically and talk about how market making works in financial markets. So all centralized exchanges and also some DEXes use something called the central limit order book, or CLOB for short. On a CLOB, market makers post limit orders that other people can trade against. And another term for this is resting liquidity. So a limit order just says, I'm willing to buy at this price, and I'm willing to sell to you at this price. And there's always a gap between the two prices, and that's called a spread. What is a maker versus a taker? So in marketplaces, in every transaction, one of the parties is called the maker and the other one is a taker. So let's say I say I'm willing to sell at $1, right? And somebody else says, well, I'm willing to buy at any price better than $1.01. So there we have a match, and the exchange matching engine is going to match us or fill those orders. One of us is going to be considered a maker, and the other one's considered a taker. If you place a market order on an exchange, you're always a taker. If you post a limit order, you can be either a maker or a taker. And typically, the algorithm that exchanges use to determine who's a maker and who's a taker is based on price-time priority. So who offered the better price and who was there first. Okay, I'm going to throw some more terminology at you, right? So these are the KPIs that as a market maker we care about. So we pay attention to the spread. The spread is the distance between the best bid and the best ask price on the order book. We care about the depth. So the depth tells us how much can we transact. If there's not much depth on the order books, you can't transact very much. The term that we use for that is saying that liquidity is very thin, or the order books are very thin. We also care about uptime. So uptime is what % of the time are we there quoting on the exchange. As you can probably infer, speed is incredibly important for market makers. Why is speed so important for market makers? Because we're basically quoting around the midpoint, around the price. And the price in any market is constantly fluctuating. It's constantly moving. So we have to move along with that price. And if we're too slow, we can get wiped out. All right, I'm going to dive for a moment into a very high-level look at market-making infrastructure and really kind of lift the veil and tell you guys like what the architecture of a market-making firm looks like. So there are exchanges. We connect to the exchange via an API. In traditional financial markets, it's typically a fixed API. In Web3, it's more commonly a WebSocket or REST API. There are a couple of exchanges that offer fixed, but it's not common. Then from that exchange, via the API, we get in real-time market data. And then we have to normalize that market data because every exchange has a slightly different way of formatting their data, and we just need to normalize all of it across all the different exchanges. So we're tracking that data in real time, and we're also gathering, this historic book of market data. The historic market data goes into something that's called the simulator. So the simulator is something that we built ourselves, which is meant to simulate the behavior of an exchange. It's basically like a shadow exchange, like a sandbox exchange that we can play around in and test out different algorithms in. While the exchange simulator is how we build our trading algos. So on this graph, everything that's below the dotted line is research and backtesting. Everything that's above the dotted line is what's happening in real time, right? So we have these trading algos that were built using simulations. And then in real time, what we're doing is we're feeding the real-time market data into those trading algos, and they're spitting out orders, right? Buy this much at this price, sell this much at this price. Those orders go into what's called a normalized OMS. OMS stands for Order Management System. What the OMS does is it translates our orders into the specific format that's needed for each specific exchange, because again, every exchange does things a little bit differently, and then it feeds that back to the exchange, again, via the API. So as I said before, speed is incredibly important to market makers. Our end-to-end latency, which is this entire loop in the top, right, from when we get data from an exchange to when we spit an order back out to the exchange, that latency is less than 3 milliseconds. Okay, so what do market makers do in the marketplace? What's their function? I want to be very clear here about what market makers do and what they do not do. So market makers can help you solve your cold start problem. So the cold start problem is if you're launching a new exchange or you're launching a new token on an existing exchange, you don't have very much liquidity in the beginning, right? You don't have very many buyers and sellers. So if you don't have very many buyers and sellers, it's very hard for people to transact. We solve that problem by, as I said before, providing resting liquidity and adding depth to the order books. We tighten spreads. I have another slide later on where I'm going to show an example of how we do that. And we smooth price discovery. So smoothing price discovery, what that means is if you look at an order book without a market maker, you'll see what's called price jumps, where the price is at $1 and then it jumps to $1.10 or it jumps down to 90 cents. That makes it very difficult for participants in the marketplace because maybe they wanted to transact at a price in between, but they weren't able to do that. So market makers, one of the things we do is we minimize price jumps. What we do not do is control prices, control volume. There's a whole host of unethical and illegal things like spoofing, wash trading, etc., that market makers do not do. If you're ever looking for a market maker and you talk to somebody who tells you that they can help control your price or they can guarantee volume, run away from that market maker. So here's an illustration of some of the things that market makers can do for marketplaces, right? So the first one is tightness, reducing the gap between the bid and ask price. So you can, imagine if if the gap is tighter, right, then it's less expensive for people to transact. If there's a very large gap, then it's quite expensive because it means that there's a big difference between what buyers are willing to buy at and what sellers are willing to sell at. Second one is depth. So if you look at some of these order books that don't have market makers, there might be like a couple $100 of liquidity on the books, which means that if you want to place an order for $10,000 worth of something, you just can't. Or you're going to move the price a huge amount, or it's going to take you a very long time to place that order. And then the third thing is resiliency. So after an order executes, how quickly does that spread snap back? How quickly do we get back to an efficient market? So this is an illustrative example of what market makers do, okay? This graph here is the average spread in the US equities market starting from 1994 over there, 2014 over there. In the 1990s, that's when electronic trading and electronic market making first emerged, right? It didn't really exist before that. So you can see that in the 1990s, even in the US equities market, which is the most liquid market in the entire world, the average spread was about 100 basis points, or 1%. 1% is huge. Nowadays, the spread in the US equities market is typically like 1 basis points, or 1/100th of 1%, or even less than that. And why this happened is because of market makers. Okay, so I'm going to close out the conversation by talking about DeFi, because this is the DeFi stage. Everything that I've been talking about so far applies to CLOBs, or central limit order books, which is the type of trading that happens on centralized exchanges. Now, DeFi has given us a whole wonderful new world of all different kinds of exchanges. I'm going to quickly talk through some of the different variations, right? The pros, the cons, and the role that market makers play. So you can think of this as a taxonomy of different DEXes. So the first type of DEX that emerged was UniV2, the original, the pioneer. This is called a constant product AMM. It's a very simple formula, right, by which you create a liquidity pool, and then two people can swap assets without any active market makers existent in the market, because as is in the name, it's an automated market maker. There are no market makers in UniV2. The pros of this is it's very simple. The downside of this is it's extremely capital inefficient and it's expensive. Transaction fees on UniV2 are like 5 to 10 times what you find on centralized exchanges. Then we had the innovation after that of UniV3. So UniV3 gets closer to what a central limit order book looks like with the innovation of concentrated liquidity, where instead of just providing liquidity to the pool, you're providing liquidity in a specific range, right? So that is much more capital efficient, but it requires active management, and it's very difficult to do, to be honest, unless you're a professional trader. Another variation of AMMs is what's called stable swaps. So stable swaps are great because they have much lower slippage, but you can really only use them for assets that are pegged to each other, like stable coins. You can't use them for non-stables. There are some DEXes that are trying to do central limit order books on chain. I think this is really fascinating, to be honest. I think this is the future of where we're going to go with DEXes. But right now, the infrastructure is still problematic, right? Because in order for a central limit order book fully on chain to work, you need much higher throughput, you need much lower transaction costs. So DYDX is probably the most well-known CLOB on chain. And they're now, migrating to being fully on-chain. But when they started, the matching was off-chain, and then the settlement was on-chain. And the reason why the matching was off-chain is because it was just impossible to do it on-chain. It's too slow, too expensive. Another variation of DEXes is Oracle-based, like GMX is probably the most well-known example of an Oracle-based DEX. So as a market maker, our role working with Oracle-based DEXes can be to stream data to oracles. Oracles are fantastic because they're informationally efficient, right? They don't start from this naive place of no knowledge about reference pricing, the way that AMMs do. But the downside is that they are susceptible to economic tech. So if you guys have heard of what happened to Mango Markets last year, that was an example of an Oracle-based DEX that got manipulated. And then finally, request for quote DEXes. So this is basically the opposite of how a CLOB works. So with a CLOB, the exchange sends you market data, and then you say, okay, I want to sell or I want to buy at this price, right? With an RFQ, the market makers, oops, my computer died. With an RFQ, the market makers are the ones streaming pricing in. So, for example, Hashflow is one of our partners. We are constantly streaming prices then, saying we'll buy at this price, we'll sell at this price, and then you can go to Hashflow. Oops. Sorry. Right, so traders can go to Hashflow and there's no slippage because you're seeing prices that are already being streamed in by market makers at which they're willing to transact. So the main benefit of an RFQ DEX is that there's no slippage and it's MEV resistant. This is just what the DEX landscape looks like today. I know that there are a lot of projects very actively working on innovating in this space, coming up with new ideas. I fully expect that in the next few years we're going to see things that are not here on this slide, and it's going to be super exciting. Cool. Thank you, everybody, for listening. If you have any questions about market making, happy to take those questions.